If you got a fixed rate mortgage in 2020 or 2021, you made off like a bandit. However, that doesn't necessarily mean that a fixed rate mortgage is always going to be the best option for you. And in my previous video, we discussed why you shouldn't choose a variable rate mortgage. And in this one, we're going to discuss why you shouldn't choose a fixed. And yes, there are some reasons why you shouldn't choose a fixed rate mortgage, and they are important. But before I get into it, my name is Nolan Matthias, and this is the place to find Canadian real estate and finance information. So if you're not already subscribed, or if you thought you're subscribed, but you're actually subscribed to my other channel, well, make sure you hit the subscribe button on this one and hit the like button so more people like you can see this video. Okay, so let's talk about why you shouldn't choose a fixed rate mortgage. Now, it is my belief that no matter what is happening in the market, in the economy, if you can get a fixed rate or a variable rate for significantly cheaper than the other option, you should always choose the cheaper option, assuming, of course, that you have the risk tolerance to deal with a variable rate. But let's say you want to go beyond that and you want to go beyond just choosing whatever the lowest rate is at the time, and you want to really understand the difference between a fixed and a variable and why a fixed rate option might not be the best option for you. And there are some reasons why. Well, there's 5 things that you really need to know. And the first reason why you might not want to choose a fixed rate mortgage is if you think interest rates are going to go down. And I mean go down a lot. Because, for example, at the time of this filming, variable rates are priced around 6%, fixed rates are priced around 5%, and one might be inclined to choose a fixed rate just because it is significantly cheaper, or one might be inclined to choose a variable rate because they think interest rates are going to come down. But in order for you to actually save money with a variable rate, if interest rates do come down, they not only need to come down that full percent, but they need to come down significantly more than that. And the likelihood of them dropping by 1 or 2% is low. Now, keep in mind when I say the likelihood of that happening is low, well, the likelihood of interest rates going up by 5% in a very short period of time in 2022 was also low, but it happened. So the key thing here to remember is that even if you think interest rates are going to come down a lot, there also needs to be enough bandwidth when they do come down for you to actually save money. So don't take a variable rate thinking, oh, interest rates are going to be lower and that's going to be the better bet, because it might not always be the case. The choice between fixed and variable really does come down to risk tolerance, and that's what you have to think about first and foremost. Now, the second reason why you shouldn't choose a fixed rate mortgage is if you're just willing to take the risk and go variable. Because more often than not, a variable rate mortgage will save you money, assuming that you can get it at a comparable rate to a fixed rate mortgage, which at the time of this filming, you can't. But let's say the market turns and you can get a fixed rate mortgage for a pretty similar price to a variable rate mortgage. Well, more often than not, the variable rate mortgage is going to outperform. So if you have the risk tolerance and the prices are comparable, it may make sense for you to take the variable rate, since statistically that is the option that most often saves the most money. And let's call a spade here. That is a very minor reason to consider not choosing a fixed rate mortgage. But here is a significantly more important reason why you might not want to choose a fixed rate mortgage. And that is if you want to avoid a big penalty. And keep in mind, there's 2 types of penalties that can arise from a fixed rate mortgage. There's the type of penalty that you get at a big bank, which is a very, very expensive interest rate differential if interest rates are lower at the time that you need to pay off the mortgage. And then there is the smaller and less expensive interest rate differentials that come along with what we call monoline lenders, or A++ lenders. These are the lenders that take on the best clients in the industry and often have a significantly better mortgage product than the big banks because they have to. And these savings on the penalties at these lenders can be significant, up to 3 to 5 times less than what they would be at a big bank. But that being said, let's say you foresee some sort of circumstance in the future where in the next 5 years, you are going to have to pay out your mortgage. Well, that may be an indication that you want to choose a variable so that you have no payout penalty exposure. Because let's say you know that you're going to have to move in 3 years, or you might need to pay out the mortgage and refinance in 3 years. Well, if you've got a massive penalty, that may be something that prevents you from being able to do the things that you want to or need to do. And I need to be clear here, because the fastest way to give a significant amount of your money and your equity to the bank or to a lender is by having to pay out a 5-year fixed mortgage in the middle of the term. And statistically, by the way, most Canadians don't make it past 3.7 years on their mortgage. So there's a high likelihood that most people are actually going to have to pay a penalty, which is why you may not want to consider a fixed rate mortgage if you know that that may be you. And that leads us into the next reason why you may not want to choose a 5-year fixed mortgage. And that is because there's the possibility that you may need to move. Because if you do need to move and you do have a massive penalty, that could prevent you from being able to move and sell the house because you may find yourself in a situation where you don't have enough equity for the next down payment. So something that's really important to consider here. And then last but not least, the last reason, and I've already talked about this a little bit, that you may not want to choose a fixed rate mortgage is because you may want to refinance and pay out the mortgage within that term. And if you end up in a situation where interest rates have gone down and you've got an interest rate differential, you may not have the options that you want in order to do the things that you need to do. Now, the best way to make sure that you get a 5-year fixed mortgage that has a low penalty, if that is something that you end up choosing to do, or even determine whether a fixed or a variable rate mortgage is right for you, is to talk to a mortgage broker that you trust. And if you don't have one, you can reach out to me and my team at mortgage360.ca in order to make sure that you get the best mortgage for you. And not only the best mortgage for you, but one that you understand and know the reasons why it is the best fit for your personal circumstances. So go to mortgage360.ca to have us handpick a mortgage for you. And if you want to look at the video that I did previously on this, which is why you shouldn't choose a variable rate, well, make sure you check it out right here.